The separation principle is the idea that a central bank like the Federal Reserve or European Central Bank should separate its lender of last resort function from its monetary policy function. While both functions are related to the overall stability of the economy, they address different aspects. Let's define these functions: lender of last resort and monetary policy. The lender of last resort function is responsible for addressing financial stability concerns, such as bank runs or liquidity issues during times of crisis. Monetary policy, on the other hand, is responsible for addressing price stability and full employment. The central bank influences the supply of money and interest rates in order to target these goals. The separation principle is intended to prevent conflicts of interest and ensure that monetary policy and lender of last resort functions are carried out appropriately. In general, the lender of last resort functions on a more reactive measure, such as the Fed stepping in this past week to backstop Silicon Valley Bank, while monetary policy, on the other hand, is a more proactive measure. When a bank run occurs, it means that depositors are withdrawing their funds en masse, which can lead to a liquidity crisis for the bank, which just means that the bank doesn't have enough funds on hand to meet withdrawals. In contrast, insolvency refers to a situation where the bank's liabilities exceed its assets. There's not enough money at all. The lender of last resort function over the past week appears to have addressed both liquidity concerns and insolvency problems. Our banking system uses a fraction of its reserves as collateral for lending. This framework is called fractional reserve banking. Not all the deposits that a bank take in are readily available for withdrawal because they typically invest or lend out the majority. When a run on the bank depletes the fraction of reserves, the bank may be forced to sell those investments, take on new debt, or sell more equity to meet its obligations. See our Market Perspective video on Silicon Valley Bank and consumer asset protection for more on this topic. For banks, selling investments that have lost value can take them from illiquid to insolvent quickly. The central bank, as the lender of last resort, was created to help banks recover from illiquid events, to avoid making a bad situation worse. Unfortunately, as individuals, we don't have a lender of last resort like the central bank. Planning for your short-term liquidity needs while protecting your purchasing power over the long term is our MO at Vector. It's our business to help you avoid a run on the portfolio, a sort of separation principle home edition. If you have questions about this topic, let us know. As always, contact your advisor if there are changes in your financial life.